Welcome to the Real Estate Espresso Podcast, Tuesday, August the 2nd, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Mirage. On today's show, we're talking about the impact of energy on the economy. There's a narrative in political circles that's disconnected between energy, the environment, and the economy. Now, this is a real estate podcast, but real estate doesn't perform as an investment vehicle in a vacuum. We're a strange place in energy and commodity markets where we have falling energy prices. There's numerous analysts in the mainstream media offering interpretations that frankly seem more politically motivated and, in my view, disconnected from the supply and demand fundamentals. The result is a mirage of economic signals that could be very misleading if you were to make business decisions based on those metrics. The Biden administration is making weekly decisions to draw down the strategic petroleum reserve by nearly 1 million barrels a day. In recent weeks, the drawdown, for example, last week was 5 million barrels. My personal opinion is that this move to use strategic petroleum reserves at a time when we have rising risk of renewed Cold War against the backdrop of a hot war in the Ukraine is nothing short of irresponsible. The strategic petroleum reserve was at 85% of capacity at the start of the war in Ukraine. These reserves have been bled down to levels not seen since 1985. This is a time with global rising tensions. The strategic petroleum reserve should be built up rather than being spent as an election bribe in advance of the upcoming midterm election. The roughly 1 million barrels a day distortion in the market is not being properly discounted by energy traders, and in my opinion, we can expect oil prices to be headed higher. Perhaps the Biden administration is thinking they'll keep spending oil from the Strategic Petroleum Reserve until the election. But that would be a dangerous move for energy security in the United States. Saudi Arabia is not going to increase production, despite friendly signals following President Biden's visit to the Middle East in mid-July. They don't really have the capacity to increase production, very much above current levels. Now, there is talk of falling energy demand as the economy slows. There's talk of building oil inventory on a global short-term basis. There's talk that Russia has succeeded in evading international sanctions when it comes to oil. Even Saudi Arabia has been buying Russian oil at a discount for domestic consumption so they can sell more of their own oil internationally for export. Perhaps the Saudi imports of Russian oil will enable a modest increase in Saudi exports. But there are signs Saudi Arabia has reached peak oil. And peak oil is the point where production will decline as reserves in the ground get depleted. The big issue is that we've experienced a decade of underinvestment in energy, followed by 2 years of dramatic underinvestment during the pandemic. 2022 has seen a resurgence in drilling activity in the U.S., and domestic production is now running at about 12 million barrels a day. This is still 1 million barrels a day short of production quantities in 2019. On the natural gas side of the market, we have a 20% reduction in U.S. LNG export capacity as a result of the fire at the Freeport facility last month. Initially, it was thought the facility would be offline for no more than a couple of weeks, and now it's looking like the plant will be offline for at least 120 days. At the same time, Russia is starving Germany of natural gas by delivering only 20% of normal flow of the natural gas through the Nord Stream 1 pipeline. This is going to make it difficult for Germany to stockpile any reserve for the coming winter, which will force Germany to make the difficult decision whether to restrict heating gas for domestic heating or restrict gas for industrial manufacturing. Manufacturers have already been put on notice they will be subject to gas restrictions this year, and German companies are rapidly trying to adapt and move manufacturing to locations where there's access to abundant sources of energy at low prices. This could ultimately benefit those locations in the U.S. along the Gulf Coast that have a strong pipeline infrastructure and some of the lowest energy costs in the world. But perhaps the lowest energy costs can be found in those locations where energy is literally being wasted. Many wells were drilled for oil and produce natural gas on the side. But if the pipeline infrastructure doesn't exist, the oil company has little choice but to flare the gas at the wellhead. As LNG capacity grows in the U.S., we might see increased international demand consuming U.S. gas and causing prices to rise in the U.S. to the point where adding that pipeline infrastructure makes economic sense. I personally hate the notion of all that energy going to waste and causing pollution with zero economic benefit. The drop in energy prices we've witnessed in the past month is not an indication that inflation has peaked. It's not an indication of reduced demand due to economic slowdown. It's a result of the government putting their thumb on the scale and distorting the market for political gain. It's a mirage. It's an illusion that, frankly, will impact the economy for years to come. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.